Okay. Right. So as usual, before we start, just a quick look at the disclaimer. Right. Okay. So the information, context, opinions which are expressed in the presentation and on the following slides are solely those of the presenter and not necessarily those of Vantage, and are solely used for educational purposes, as they do not constitute investment advice and or consultation on how a client should trade. Also, do take note of the risk warning that comes with trading margin effects and CFDs. They carry significant risk and is not suitable for all investors. You could lose substantially more than your initial investment. All right. All right. Now, okay, here's the agenda for today. As we mentioned, we're going to be covering Elliott wave theory. So we'll start off with the principles of Elliott wave theory. Then we'll look at what are the two main components of the Elliott wave. We have the first half, which is called the motive or the motive wave, and then we have the corrective wave. So basically, the Elliott wave has two major components. One's the motive, and then the other is the corrective. And then also we'll look at uh, the respective wave structure and degrees within the motive wave as well as the corrective wave. And then we can also see how this relates to Fibonacci ratios and what are the guidelines to follow when we try and practice Elliott wave theory. All right, so my name is Ketan Ramachandra. I'm an investment analyst here at Everest Fortune Group. So this webinar series is brought to you in a special partnership by Vantage Markets and Everest Fortune Group, where Everest Fortune Group has been the finalist for Best FX and Equity Research for the following years, 2019, 2020, and 2021. And everything here, all right. Okay, I just want to make sure everything was all right on Zoom as well. Okay. Okay, so basically just a bit of background on what is Elliott wave theory. It was developed by this person called Ralph Nelson Elliott back in the late 1920s. He noticed repetitive patterns in markets, right, which he attributed to the psychology of masses. Now, this could be for any market, right? It could be for the stock market, currency markets, commodity markets. So it could be any instrument, any security, and you could apply this theory to any asset class, basically. Right. So he noticed this large repetitive patterns and he divided it into smaller patterns, which he called waves. So right. So that's why it's called Elliott wave theory, right? It was developed by Ralph Nelson Elliott, and he noticed repetitive patterns, which he called waves, right? Okay, so every transaction is both produced by meaningful information and produces meaningful information. The wave principle is not primarily a forecasting tool. It is a detailed description of how markets behave. But because we know that there's a motive wave and a corrective wave, generally many traders have used it for forecasting as well. All right, now that we know that there's just let me adjust the camera. It seems to be eating into the slides a little bit. Let me just make it a bit smaller. Yeah, I think this should be a bit better for everyone. Right. Okay. Right. Okay. So as I mentioned earlier, Elliott wave is made up of two major components. We have the motive wave, which is the first half, and then we have the corrective wave. All right. So motive wave is the first half of a complete Elliott wave cycle. Okay, so it advances in the direction of the trend of one larger degree and is subdivided into five smaller waves. Right. Um, Sorry, okay, where was I? Right, it advances in the direction of the trend of one larger degree. So this is the trend with a bullish trend here, and is divided into five smaller waves. So the three of these waves, which are labeled 1, 3, and 5, they are called impulse or actionary waves. So in this case, they are the waves that are depicted by the green line. So it's usually upward, obviously, in the bullish trend. And the impulse waves are separated by two diagonal or corrective waves labeled 2 and 4, which you see here highlighted in red. Right? So we can see this is wave one, this is wave two, or sorry, wave three, and this is wave four. So you take wave one is here, right? This is wave one, this is wave three, and this is wave five, right? So these are all uh impulse or actionary waves, right? They follow the trend, the larger trend, which is upward. Now, and then we also have the corrective waves, which are labeled 2 here. There's like corrective waves 2 labeled 2 and 4, right? Because they are the corrective move in the upward trend, right? So this is what it means here. Okay, hang on. There's a question on Zoom. All right. Oh, and hi, Jamilu. Good to see you as well. All right. Thanks for attending this webinar. All right. Okay. Just keeping track of all the questions that come in as well. All right. So some basic rules that we should stick to when it comes to the motive rules. All right. So basically, when we see here, right, this is the move starting point. Let's just say this is starting point, point 0, point 1. So if we use, let's just assume that this is 0% and then this is 100%, right? That means wave 2 cannot retrace more than 100% of wave 1. So that means if wave 2 goes below this level, that means this is not a motive wave, right? What we are seeing in the markets or in the price is not a motive wave, so you cannot apply Elliott wave theory in that aspect, right? So that's what this point means, right? So wave 2 cannot retrace more than 100% of wave 1. So that means it cannot go below the starting point, right? So here we go. So that's what it means. Right now, wave 3 can never be the shortest of wave 1, 3, and 5. So what this means is, okay, so we see wave 3 here. So that means wave 3 can never be the shortest. So if you have wave 1 here, wave 5 here, wave 3 has to be at least longer than one of them. So that means it has to be longer than wave 5, or it has to be longer than wave 1, or it can be longer than both waves 1 and 5, but it cannot be the shortest wave in the series. All right. So that's what it means. Wave 3 can never be the shortest of waves 1, 3, and 5. It has to be longer than either wave 1 or wave 5, but it can be both of them as well. Now, these are the rules. These are the unbreakable rules, because if this three rules, oh, sorry, I didn't cover the last one. And wave 4 can never overlap wave 1. Now, what do we mean by that? That means wave 4 can never retrace to where wave 1 ended. So think of it as, say, this is a swing high resistance. So when price broke out of this resistance, this is now a support. So when wave 4 is correcting, it can never go below this support level. Right? You can think of it as that way as well. So when you have that happening, say you have wave 1 play out 2 and 3, and then suddenly the wave 4, the corrective wave, goes below the peak of wave 1, that means this is not an we cannot apply Elliott wave theory to this part of the price structure, right? So that's what it means. So do take note, these are 3 unbreakable rules, and they must be adhered to if we were to implement Elliott wave theory. Right, okay. Then what else? Right. Let me see if there's any questions coming in or anything like that. Okay. Right. Okay. Now we're going to look at the corrective wave, which is the second half of the Elliott wave. All right. Okay. Before I get on to corrective wave, is there, do you guys need me to go through the motive wave rules again? I'd be more than happy to go through the motive for the rules for the motive wave. Okay. If not, I'll just quickly do a recap. Remember, wave 2 cannot retrace more than wave 1. So that means it cannot go below the starting point, right? Then wave 3 cannot be the shortest. That means wave 3 here has to be longer than wave 1 or longer than wave 5. It can be longer than both of them, that's fine, but it has to be longer than at least either one of them. And the final one is wave 4 can never overlap wave 1. That means this corrective move down here cannot go under, cannot drop below what was this resistance level here. This was a swing high resistance, which then became a support. So wave 4 can never go under the support level. All right. Now corrective wave, which is the second half of the Elliott wave cycle, right? These corrective waves are counter trend, so they move against the trend of the larger price structure. The corrective wave is subdivided into 3 waves denoted as A, B, and C. So do take note, for the motive waves, we have numerical numbers to identify the waves. right? We have 1, 2, 3, 4, and 5. And in the corrective wave, we're using the alphabet, the letters A, B, and C. So that's the difference, and that's how we differentiate between the motive wave and the corrective wave. Numbers are used to denote components of the motive wave, whereas letters are used to denote the components of the corrective wave. All right. So this is here typically what you would see as a corrective wave. So that means when you, uh, so let's put this, give it a bit of context, better context. So this is wave 5 here ending, wave 5 ending here, and we have wave 4 here, the corrective wave. So when we're looking at the, this is here would be motive, and naturally here would be the corrective part of the Elliott wave cycle. So when you have wave 4 correcting and then wave 5 completing its final leg move and starts to fall, so this is where you get the corrective move. So you have A, which is the corrective move, then B is the one that goes up, it's like the retracement move, and then you followed by C. All right, so just to recap the basic cycle structure, you have the motive phase and the corrective phase. A cycle is illustrated as a structure with a total of 8 waves, but you'll have 5 waves here in the motive half, and then you'll have 3 waves here, A, B, C, as the corrective in the corrective phase. So do take note: 1, 2, 3, 4, 5 in the motive phase, and A, B, C in the corrective phase, which gives us a total of 8 waves in the full Elliott wave cycle. This is the basic Elliott wave cycle. Right? Motive, corrective. And then when you break it down, you will see waves. You would generally see waves 1, 2, 3, 4, 5, and then in the corrective phase, A, B, C. Right? So just to take note, this is what on a larger or a top view would look like of a basic Elliott wave cycle. Right? It's the top view, a very top view, bird's eye view of the Elliott wave cycle. Motive wave, which consists of 1, 2, 3, 4, 5, and then you have corrective phase, which consists of A, B, C. And then when you break it down, this is what it looks like. Okay. All right. So it's a very repetitive structure. As mentioned at the start, uh, Ralph Elliott noticed this repetitive patterns across various markets, across various instruments. And that is how he came into recognizing it. Now, what is also important is this is uh, within each wave as well, of course, within each wave, you can have that price structure repeat itself, right? So what I'm trying to say is this is one big Elliott wave cycle where we have the corrective, the motive phase and the corrective phase. But within wave 1, you can have this whole structure repeated within wave 1 as well. So the next slide is going to show you that. So you're going to see this 1, 2, 3, 4, 5 ABC. So this 8 wave pattern or this 8 wave structure be repeated in just wave 1, and also you should be seeing it in wave 2, 3, 4, 5, and so on and so forth, right? So let's just go to the next slide and see what we mean. So here within wave 1, you have the wave corrective wave again, 1, 2, 3, 4, 5, and then when you have wave 2, within wave 2, uh, you have the corrective phase A, B, C. And then when you're still going up to wave 3, you have the 1, 2, 3, 4, 5. And then when you're going in the corrective wave for wave 4, you have A, B, C. So you can see that this pattern can be observed in the lower time frames as well. So you just have to assume that this is like, for example, we are seeing this on a daily time frame, right? You're seeing this on a daily time frame. Uh, but then also when you zoom in a little bit, you can see this price structure repeating itself because price doesn't go from point A to point B, from one point to the other point in a straight line. It is going to retrace and pull back along the way. And that's why you can see this repetitive structure, 5-3 structure or the 8-wave structure repeat itself within that uh, within that wave 1 or 2, right? So you have 5 advancing waves that make up wave 1, 3 declining waves that make up wave 2. Then in waves 1 and 2 of wave 1, the general 5-3 Elliott structure forms. Now this market is repeated. The market repeats this 5-3 structure again and again until the cycle begins. So each wave and cycle can be part of a bigger 5-3 structure, right? Okay, so just to recap, this is the basic Elliott wave structure, right? Or the wave cycle where you have the motive wave, corrective wave. In the motive wave, you will see have the 5 waves, 1, 2, 3, 4, 5, and then you'll in the corrective phase you'll have A, B, C, which is what we see here, right? And then if you go another step lower, you can see this 1, 2, 3, 4, 5 A, B, C, this whole structure play out in just wave 1 as well. And then you'll see it out. And that's what we mean here. So we see it played out in wave 1 to 2, 2 to 3, 4 to 5, right? So that's what it means. That's why you see here 1, 2, 3, 4, 5 A, B, C. 1, 2, 3, 4, 5 A, B, C. Then 1, 2, 3, 4, 5 then this is a corrective wave. So up to here, you'll see it like this. Yeah. Then when you go into the motive phase, it'll be 1, 2, 3, 4, 5, A, B, C. It's just the inverse, right? This part is just the inverse. Okay. Is there any questions? Is there anything that you would like me to repeat before going back? Because I do understand that when you first encounter Elliott wave theory, it can be a little bit confusing, especially with the different wave structures and the corrective wave and the motive wave, and you have the different advancing and declining portions of that wave. So, if there's anything you would like me to repeat before we move on, I'll be more than happy to go through it with you. Because do not worry, because the first time when I encountered Elliott wave theory as well, it was a little bit confusing for me personally as well. It took me a little bit of time to understand it properly. Right. Okay. If not, all right, then we'll just continue ahead with the rest of the presentation. All right. Okay. Now, how can we relate Fibonacci retracement levels with Elliott wave theory? Right. The good thing is we can use Fibonacci ratios to help us measure the target of a wave's moves, and this can also help us to determine uh, good entry levels and take profit levels, as well as identify stop loss levels as well. All right, there's a question on Zoom. Hello. All right, hi Harris. Yesterday at 16:19 GMT plus 2 time, gold had a sudden drop of 40p. There was no news. What could have happened? I'm new to trading. Okay, GMT plus 2, you're on 16 hours. So that means 4 p.m. GMT time. Basically, last night there was no major news, but we did have uh, FOMC member Neil Kashkari. He conducted what is it? Was it an interview or something? I can't remember. He had an interview or a panel discussion at one of the Fed meetings, and he was very hawkish during this period, right? So what do I mean by hawkish? That means he reiterated the Federal Reserve's desire to maintain interest rates higher for longer. He also reiterated the call to raise one more rate hike in the last quarter of 2023. So these are all very bullish uh, words for the US dollar. So that means the demand or the value of the US dollar will increase. And we all know gold and the US dollar has a negative correlation. So what does that mean? So that means if the value of the US dollar goes up, gold drops. And if the value of the US dollar drops, gold goes up. So this is the general relationship that gold and US dollar has. And so when when the FOMC member Neil Kashkari was giving his remarks, he turned out to be very hawkish, signaling higher interest rates as well as keeping interest rates higher for longer. So this all act as a bullish catalyst for the US dollar, which in turn drives gold prices lower. So this is quite likely what happened yesterday, right? yeah, this is what I can tell you as of now. Yeah, there was no major there's no major economic event for sure during that period. But we did have uh, uh he's the he's the Federal Reserve President for Minneapolis. So yeah, so that's what he was. He did have a some sort of interview or a panel discussion going on last night during the US hours. All right, okay. I hope that's answered your question. All right, okay. Now back to Fibonacci and Elliott wave. Okay. Oh, is there another question here? Right, okay. Sorry, just toggling through, making sure I don't miss any of the questions. Just toggling through both the platforms. Do remember, we're zooming in through Zoom and on the Vantage app itself directly. All right, now a little bit of how we can incorporate Fibonacci into Elliott wave theory as well. Right. Remember, we said at the start, we said wave two, when it's correcting, it cannot go below the starting point of wave one, right? It cannot go below the starting point of wave one. Now, how do we do that? And also okay, that's one thing we know. Now, how do we incorporate Elliott wave or Fibonacci retracement into this? So what we're trying to see here, wave two typically ends at the Fibonacci retracement level at 61.8%. Now, if you for those who may not be familiar with Fibonacci retracements always start from left to right. So if it's a part of an upward move, bullish move, you would start your retracement from the bottom left swing low to the top right swing high. And if price is falling, you would start on the top left swing high and you'll end on the bottom right swing low. Now, do take note every time you use the Fibonacci retracement tool. Oh, yes, pardon me. Every time we use the Fibonacci retracement tool, do take note the starting point is always 100% and the ending point is 0%. Right? Okay. So similarly here, when you do it from the top left to bottom right, on a downtrend, the starting point is 100%, the ending point is 0%. So that means when we are using applying Fibonacci retracement on wave one, we are starting here. So this is 100%. And when you end the retracement here, this is 0%. So what this means is wave two will retrace up to 61.8%. All right. So that's what it means here. Now, what else? So for wave three, right? Wave three. Oops, did I miss? Yeah. Okay. So for wave, so that's covered wave one. Okay. So wave one, you do the Fibonacci retracement as price starts to pull back. You pull the Fibonacci retracement from this swing low here and then swing high here at point one. You have 100% here, 0% here. So 61.8% would be here. So price usually pulls back as far as the 61.8% retracement level. Now, when wave three begins, right, typically wave three usually is 161.8% or 261.8% extension of wave one, right? So what is wave one here? Uh, so basically you're looking at this extension point. You're looking at the extension from 1 to 2. So in this case, you'll still use the Fibonacci retracement tool. You'll start from point 1, which is 100%, and you'll end at point 2, which is 0%. And then when you look at the extension levels, do remember Fibonacci extension levels are levels that are greater than 100%. So since the starting point is here at point 1, so 100% is here. So naturally, all the levels greater than 100% will be up here. So that means wave 3 will typically end at 161.8 or 261.8%. So that's what it means. And that's how you can use the Fibonacci retracement tool. So when you see wave one being formed, then wave two being formed, and then as wave three is rising, you use the Fibonacci retracement tool, start from this swing high here, going down to the swing low here, 100%, 0%, and you're looking for the extension levels at 161. That would be your first, naturally, that would be your first target of where wave 3 could potentially reach. And if it does continue to rise beyond that, then the next target would be 261%. All right. Now, what about wave 4? What do we know about wave 4? All right. So wave 4, as it pulls back here, it typically it should reach 38.2%, right? So it should typically reach 38.2%. So now how do we find this 38.2%? Right? So when wave 3 is completed and starts to drop back, so it's made a swing high here, and we also see another swing low here. So you'll start your Fibonacci retracement from this point, from point 2 to point, oops, from point 2. So from point 2 to point 3, right? So we start here, this is 100%. And when you end here, this is 0%. So that means 38.2% would be somewhere here, 50% would be here. So that means when price starts to pull back, typically it should drop as low as 38.2%, and then it should form a bottom here, so to speak. It should stabilize before turning higher to begin wave 5, right? So that's what it means. Okay. So this is how we can use the Fibonacci retracement levels, extension levels, to help us identify where uh, the waves could typically end. So just to repeat, wave 2 is typically 61, typically ends at the 61.8% retracement level of wave 1. So that means this is wave 1 here. Let me just tidy things up so that it's clearer. Right, so wave 1 is here, right? So you draw 100%, you start the Fibonacci retracement from here, starting point here, ending point at here. So you get 100% here, 0% here. So you're looking for wave 2 to pull back to no more than 61.8%, right? So typically it will drop to 61.8%. And remember, wave 2 can never go below the starting point of wave 1. So typically when wave 2 is correcting, it should drop as far as the 61.8% Fibonacci retracement. So that's how you can use Fibonacci retracement here to identify where wave 2 will end. And because if you still believe that this instrument is going to rise higher by using the Fibonacci retracement at 61.8%. This is typically where you can identify a potential buy entry or buy level or a support level for the price. And then as price consolidates around this level and starts to turn higher, that's when you know that, okay, now it's quite likely that price is beginning, is starting on wave 3, right? So now when wave 3 begins, you're going to be looking at how are we going to identify, like, for example, a take profit level, right? So you've used 61.8% to identify your buy entry here. Now you've gone long on the instrument. You're trying to see where will you take your profit. You can use 161.8% Fibonacci extension level. So for this case, you start your starting point here and you end at this ending point here. So that means this is now 100%. This is 0%. So naturally, all the extension levels are above here. So your 161 Fibonacci extension level would be around here. Then for wave 4, as price is correcting once again, and you believe that this is still part of a bullish trend, and you're looking to go long on this instrument again, so you would use the Fibonacci retracement starting from point 2, ending at point 3. So this is 100% here, 0% here, 38% retracement is here, 50% retracement is here. So you're looking for price to pull back to about 38.2%, no more than 38.2% before reversing to go higher. So once it's finds support close to where the 38.2% Fibonacci retracement level lies, that's when, and you see price turning up, and maybe you have other indicators to help you identify the turning points as well. That's when you know that, okay, now price has started on its uh, wave 5, and this is where you can go long on the instrument again, right? So this is how you can combine Elliott wave theory and Fibonacci retracements and extension to help us identify buy entries and take profit for the bullish trend of the move, for the bullish part of the move. All right. Now, next thing we're talking about wave alternation. So what is this wave alternation? Right. So basically what this means is wave two, right, which is this part here, and wave four, which is this part here, they will typically alternate in shape or style. So if wave two is sharp, wave four will be sideways. So in this case, we can see sort of it has a much sharper pullback, right? You get this is descending lower, making lower highs, lower lows. So this is what we call is a sharp uh, corrective move. Then typically wave four would be more of a sideways action. So that means wave four would be consolidating or range bound between two levels. Then similarly, if the opposite were to happen, that means if wave two is sideways, then wave four will be sharp. So that's what we will see here. So in this case, uh, okay, this shouldn't be sharp. This should actually, this shouldn't be flat. This should actually be sharp. So what you're looking for, wave two is sharp, wave four is sideways. And then, let me clean this up. Then of course, if wave two is sideways here, if wave two is sideways, then wave four should be sharp. So do take note. Sorry, apologies for this. This shouldn't be flat. This should be sharp. So that means price is making lower highs and lower lows, right? So it's just very simple. Waves two and waves four typically will exhibit a sharp or sideways pattern, and that it means it usually alternates. So if we do see a sharp uh reversal first in wave two, that means wave four is very likely to have a sideways correction. Similarly, if wave two has a sideways correction, then it's quite likely we're going to see a sharp correction for wave four. So that's what it means, and that's how we can use it. So do take note, this is another important rule of Fibonacci Elliott wave theory as well, right? All right, wave equality. So in this case here, what do we mean by wave equality? It means that generally, uh, the corrective waves two and four will generally have the same length in terms of the pullback, right? So the length of the corrective waves for two and four typically will uh will have the equal pullback, and also wave five will be approximately equal wave one in price as well. So that means the move that you see here, starting point here to wave one, typically wave five will at least match this initial move here. So if you know, for example, that this instrument has moved, say, 50 pips in wave one, and after you see wave one, two, three, four play out, then it's quite likely wave five will uh, experience the same as well. So that means if you know this wave one has gained 50 pips, and then when you see corrective wave 4 end and price starts to go higher, then you could say that, okay, this is another way of identifying a potential take profit level as well. So say you're on a dollar yen here, this is 140, price is trading at about 140. So as this price moves up, then you know most likely my take profit could be around 140.50, right? So that's how we can use this guideline as well. So this is more of a guideline rather than a rule, right? So wave five will approximately equal wave one is more of a guideline rather than a rule. Okay, so do take note of that. And also the other one, this is also a guideline as well, is not a rule. So it means that typically corrective waves two and waves four will typically be of equal length. So that means if wave two has pulled back, say 30 pips, then it's quite likely when corrective wave 4 begins, it's quite likely this will also drop 30 pips as well. So similarly, then we are able to know that because wave 2 experienced a 30 pip drop, then it's quite likely we can sort of estimate where wave 4 will end, and then you can identify a potential buy entry, and once price has actually formed the bottom and starts to turn higher, then you can go long on that position again, and then you can use the length of wave one. Remember, we said if you assume wave one made 50 pips, then we can assume here, so say if here price started to consolidate and move higher at about 140.50, say we're on a dollar yen, then we can say that, okay, another 50 pips, that means wave five should could end around 150. Right, so that's what this guideline means, and it's quite useful, and that's why this part of the guideline is called wave equality. All right, momentum divergence. All right, this is something interesting which we will look at it with using a momentum indicator such as RSI. Right, so in this case, you can see price is making a higher high. Right, the price is making a higher high. Naturally, when you're in an upward and a bullish trend, you're in the motive phase of the Elliott wave cycle. Is the motive phase of price is generally going to obviously going to make higher highs and higher lows. Right. So when you no look at compare it with indicators such as a momentum indicator such as RSI. Generally, we can use the RSI uh, indicator to help us identify divergence in price, right? So when you're looking for divergence, what it means is although price is in this case, for example, price is rising higher, but you actually can see the momentum indicator dropping lower, right? So what this means is the RSI is potentially signaling a reversal in price action. That means wave 5 could be coming to an end soon, right? So that's what this slide is trying to show. So on the next page here, you can see here price making a higher high, and in the next animation, you can see on the RSI indicator, price is making a lower high. So this is what we call divergence, right? So if we look here on a smaller scale, here you have the RSI rising together with the price action rising. This is called convergence, right? You have price going higher. You have also RSI going higher. Similarly, in wave 4, you have price falling down, and you also see price falling, the RSI indicator dropping as well. So this is convergence where they're not uh, moving in opposite directions. So divergence basically means that price and the indicator are moving in opposite directions. So in this case, when you look at the high, like if you take a top view of the chart, you can see that price is making a higher high here on price action. But when you look at the indicator, the momentum indicator, in this case RSI, is actually making a lower high. So when you have in the momentum indicator moving down, but you have price moving up, we call this a momentum divergence. And in a scenario like this typically means that wave 5 is about to end, and we could be starting on the corrective phase of the Elliott wave cycle. All right, so that's what this slide is trying to show. All right, so just to recap on this part, uh, any questions? Let me see. No, okay. So just to recap on this part, so we're looking for momentum divergence. So that means when price is making a higher high, but momentum is making a momentum indicator is making a lower high. This type of movements are called momentum divergence, and it typically signals the end of wave 5, and then we are going to start on wave A, which is part of the corrective wave. Now, of course, this can also apply to the downside as well. So when you have A, B, C, right? When you have A, B, C, and then you have the RSI indicator dropping as well. But then it's you can see the RSI indicators actually rising, is making a lower low, but here in price is actually trending lower. So in this case, the momentum indicator is telling you that potentially wave C is coming to an end because we see the RSI trending higher, right? But price is making lower. So again, this is now another momentum divergence, but this is more of a bullish divergence. This picture here is describing a bearish divergence. Right, this is a bearish divergence. But in the opposite case, when you have the corrective wave, A, B, and C, price is making uh, lower highs, lower lows, but you actually see the RSI indicator making higher lows, right? So you have the divergence once more, and this time this signals a potential bullish reversal and ending of wave C. All right, so this is how we can apply it uh to the other side as well. All right, okay, then the depth of a corrective wave. Okay, how far can a corrective wave go? Right, the market will often correct to the territory of wave 4 of a lesser degree. So what this means is, so you have one, two, one, two, three, four, five. You have A, B, C. Right, so the corrective wave will not always reach the bottom of previous wave 4, but usually this is what an area where we are looking for it to come to an end, right? This is what it means here, right? So typically we are looking for wave C to pull back close to where wave 4 ended, right? It doesn't mean it's always going to come down to this level. It could be a little bit higher than that, but as a general rule of thumb, it'll be good to use where wave 4 ended to give you a pretty decent indication of where wave C could potentially end. And if this is still part of a larger move that's going to go up, that means you're going to start a new wave 1 here. That is good to know that this is where how you can use the wave 4 ending point of wave 4 to help you identify the potential ending point or zone for wave C. Right. So once again, so this is a good place to find support or resistance, right? Okay, so the theory limitations. Okay, wave extensions. Right. So as I mentioned earlier, remember we said within waves one, two, three, four, and five, right at the start, we saw you could see this 5-3 structure play out in the individual waves as well. So in this case, let's say wave 5 was a very elongated wave, and it can actually consist of waves one, two, three, four, and five again within the final wave five. So this is what it means. These are what I call extensions, right? So you can have an extension within wave one as well. So you can see one, two, three, four, five playing out in wave one again. And then in wave two, which is a corrective wave, you can also see A, B, C play out. Similarly, between two and three, you can see like a subset as well. Waves one, two, three, four, five play out again. And then from waves three to four, you can see A, B, C play out again, right? So this is what the extensions mean. Or this is a subdivision, right? So the extensions are basically the subdivisions as well. So impulse waves display an extension to the normal pattern, right? One of the impulse waves in the motive phase would be elongated impulse with multiple subdivisions. So as you can see, wave 4 to 5, wave 5 is an elongated impulse with multiple subdivisions, one, two, three, four, five, right? And subdivisions of the extended wave may look similar to the other four waves, resulting in a wave count of 9. So in this case, you have 1, 2, 3, 4, 5, 6, 7, 8, and 9. So this is what this point is trying to say. So sometimes you may see wave structure 1, 2, 3, 4, 5, but because of this elongated move here, you may see another wave structure of 1, 2, 3, 4, 5 here. And when you add all of them up together, that's what gives you this wave count of 9. Right now, since this extended wave is originally an impulse, and the extensions can also occur within the extensions as well. Right. Okay. So then, yeah. Sorry. This is what you get: 1, 2, 3, 4, 5, 6, 7, 8, 9. Oh, let me just clean this up again. Okay. Right. Then the types of corrections. Okay. What are the types of corrections in the corrective wave phase? Right. You have waves A, B, C that make up the corrective phase. Right. So what are these? Okay. So we know this is the motive phase, and you have the impulse waves 1, 2, 3, 4, 5. Now we're looking for A, B, and C. Right. So waves A and C are called the motive waves because they follow the downtrend, and wave B is called a corrective wave because it is the retracement higher, right? So in this case, in the upward, in the motive phase, wave one was impulse, wave three impulse, wave five impulse, wave two was corrective, wave four corrective because it's going against the trend. Now, when we are in the corrective phase, wave A are the motive waves. along with wave C. And because wave B is going against the trend, it is retracing higher, so it is called the corrective wave. So that's what it means here. Right, so you can have a zigzag correction for the corrective wave, A, B, C, zigzag pattern, very clear zigzag pattern. And within the zigzag pattern, you can also see the subdivisions as well. So we had A, B, C, right? We have A, and we have B, and then finally C again. And within that, corrective waves A, B, C. Sorry, yeah, the motive and corrective waves A, B, C. You can also see the subdivision. So you can see one, two, three, four, five, and A, B, C, and one, two, three, four, five again. Right. So just let me clear this up so you guys can see it once more. Right, we have the larger wave, motive wave A, corrective wave B, and motive wave C again. But within the motive wave A, we can also have the subdivisions again. So one, two, three, four, five. This is just moving in the opposite direction to what the motive phase was. So it's moving in the opposite direction. One, two, three, four, five. Then you have A, B, C, which makes up the corrective wave B. And then for corrective wave C, you have the subdivisions again. One, two, three, four, five. Right. So this is what it means. Yeah. So this you can have this type of corrective wave patterns as well. In So this is the main one. And of course, within it, you can have subdivisions as well. And you can break it down and label it accordingly like this. And you can also have corrections that are flat. So that means your motive wave A, corrective wave B, and motive wave C. Basically, it's range bound trading, right? Instead of seeing a clear pullback, right? Instead of saying a very clear pullback in price action, you actually see price consolidate instead, right? So in this case, this is flat or consolidation, right? This is flat or consolidation. Right, so that's what it means. So you can have a type of correction that is also flat, right? But within the flat correction, you can also see the subdivisions as well. So in this case, you can see A, B, C, A, B, C, then one, two, three, four, five again, right? So generally, when you see a flat correction, this is the application that you use, or the this is how you determine the wave structure, or the identification of the wave structure using ABC, and the ABCs at 1, 2, 3, 4, 5. Whereas for the zigzag, it's much more straightforward. It's just 1, 2, 3, 4, 5, ABC, and then 1, 2, 3, 4, 5 again. All right. Okay. So we've come to the end of today's webinar. If there's any questions, do not hesitate to let me know. I'm happy to go through any of the sections of the slides that you may have. Uh, just checking the Vantage app to make sure I've not missed any questions. All right, and also on Zoom. Right. Okay. Um, if there are no further questions, then maybe I'll just go on to Forex Factory and just let you guys know what are the key events to look out for this week. Right, today. Okay, let me just put it on GMT time first, so it's easier for everyone to relate to. Right. Okay, so I'm on GMT time. I'm going to look at the key calendar, the key events coming up this week. Right. Okay, so today in the US, we have consumer confidence data. Okay, what would be important? This also would be important, but not too sure how much of an direct impact it could have on the dollar index. But do take note of the Australian inflation data that's coming out. This is monthly inflation data out of Australia, which will be released at 1:30 a.m. GMT time. So the monthly CPI indicator has been falling uh, pretty steadily in Australia. That means inflationary pressures are receding from the market, so that's good. But the recent forecast or the latest forecast is showing inflation picking up again. Now, if the actual data matches this reading or even comes in higher than this reading, this could potentially act as a bullish catalyst for the Aussie dollar. So do take note of this economic event coming up tomorrow at 1:30 a.m. GMT time. Then we've also got US GDP coming up at 12:30 p.m. GMT. We've also got unemployment claims. This is also an important economic indicator which can drive the dollar index as well as gold prices. We also have Federal Reserve Chairman speaking on 28th of September at 8 p.m. It's a town hall event with educators. I'm not sure if we'll be touching so much on monetary policy with regards to this town hall event, but do take note, this is also another potentially a high impact event for the US dollar. Right. And then finally, one of the other key important things we have ECB President Lagarde speaking on conference this energy transition. So perhaps maybe she won't be touching on monetary policy, but do take note, she is speaking on this date at 7:40 a.m. GMT. But do take note of the core PCE price index. Okay, the PCE price index is the Federal Reserve's preferred measure of inflation, and this is coming out at 12:30 p.m. GMT on Friday. Now, of course, any PCE reading that comes in higher than the forecast, that means inflation is creeping back into the US. So that means this could potentially act as a bullish catalyst for the dollar index. However, if the PCE index shows inflation starting to slow, then that means this would act as a bearish catalyst for the dollar index. All right. Okay. Thank you everyone for tuning in today. Hope this has been a great session for all of you. Take care and do look out for all future Vantage webinars as well. All right. Thank you everyone. Take care and have a great trading week.